assume attention now in the next couple of days is the forging space. There's a company, Happy Forgings, that lists on the 27th of December, and the IPO closes as well today. So we'll keep an eye out on that. But MM Forgings is the company that we're talking about. Remember, Happy Forgings has launched that 1,009 crore IPO and will make its Dalal Street debut very soon. MM Forgings has also been bullish on demand. Vidyashankar Krishnan, who's the Vice Chairman and Managing Director at MM Forgings, joins us now. Mr. Krishnan, good morning and thanks a lot for joining in. I wanted your take on how the demand situation is panning out. You know, last time you spoke to us, you spoke about a 1,700 crore revenue guidance for the full year. That's in FY24. Are you on track to doing that? And can you tell us what are the demand triggers now for the next few quarters?
We have achieved 785, 786 crores for the first half year. And for the second half, we should be looking at something around 1,600, 1,620. That is our expectation. 1,700 looks to be a little bit out as far as this year is concerned. And the demand appears very bullish as far as we are concerned. We are investing considerably as we go forward. And apart from the investment, we are also seeing tremendous growth prospects. As we have been saying earlier, we are targeting 2,200 to 2,500 crores over the next 2-3 years.
So you're saying in FY24, your revenues will hit 1,600 to 1,620 crores, is it?
Yeah.
So it's lower than what you had guided for earlier. Earlier you said about 1,700. Okay, why is that?
It is lower than what we had earlier projected. The second half has not been as strong in the CV market, and also some sluggishness in exports, and a couple of new product launches got deferred. But however, overall the growth story remains very much intact. And next year, we plan to knock on the 2,000 crore mark, anywhere between 1,800 to 2,200 crores.
Got it. All right. Hi, sir. Morning, Nigel, on this.
Hi, Nigel.
Yes.
Morning.
Good to see you, Vince. You know, a few questions then. The new listing that we have that's going to be Happy Forgings, their margins are much better in comparison to other forgings companies. Now, you have been in that vicinity of around 18 to 19%. And a couple of drivers of that will be your machining components. As of now, machining components is how much of your total revenue mix? Where do you see that number headed? Exports are how much of the mix, and where do you see that number headed? And non-auto. So 3 parts: exports, non-auto, as well as machining components. What are they at and where do they head? Because I think over here you'll get better margins in comparison to the other part of your business.
Yeah, you hit the nail on the head. Our machining numbers are at about 58% as of now. And we would see something in the region of 70-75% as we move on. And one of the basic differences between Happy Forgings and us is they have been in significant value-added components for quite a long time, whereas we have entered into that space recently. So that accounts for a huge difference between the two organizations. The next is with regard to exports, we are at about 33% of exports. That will largely remain around that level.
Okay, and non-auto?
Non-auto stands at about 15%.
15%. Okay, and you look to increase that proportion as well?
Yes, we are looking to push that up by a couple of points.
Okay, so then what happens to your margins from this 18-19%, or do you think you can move higher from here? And also volumes for the year, earlier you were guiding for around 85 to 90,000 tons. Do you hold that?
Yeah. We would be doing about 82 this year.
Okay, and margins?
And margins would be largely intact in terms of whatever we've been doing in the first half. That should continue on into the second half. And going forward with a good mix of value-added components and also, sorry, I heard some noise. Okay, value-added components and also some margin, some expenditure compression, some cost control measures that we have undertaken, we would expect our margins to improve by about at least 2 basis points. Or
Okay,
sorry,
so
200 basis points.
200 basis points. So
200 basis points.
At what point, sure, 200 basis points. So at what point do you think you can get to that 20% margin band? I mean, what is the kind of timeline you're looking at?
We should look at this sometime in FY25.
FY25, you can get to the 20% margin band. Got it. Earlier you had said you're not looking at the EV space, supplying to EVs until the first half of FY25. You had also talked about how there is customer acquisition that's happening and there is a target of 2,000 crores of revenues for EVs by 2030. Just tell us a little bit about that. What are the potential orders you're looking at, and what is the kind of guidance that you're putting out?
I would stand by my earlier numbers, but as I have said earlier very clearly and very strongly, we have to walk the talk. The entire industry itself is in a very, very nascent phase, and a lot of evolution is taking place. However, our foray is well positioned to take advantage of the EV moves, because we are probably the only player in India, and definitely the only domestic player in India, or rather I would say local player, locally grown player in the heavier motor powertrain range, say from 15 kilowatt and above, totally indigenously developed. So as we acquire customers in these spaces, we are definite to move forward considerably.
Okay, just one final question on debt, if you can give us the number. You said the last time that debt will rise from 430 crores to almost 650 crores in 2 years. Where are we at the moment in terms of gross term debt, and what's the expectation?
We would expect to end this year close to about 480 to 500. That's on the normal trajectory, but we are also planning aggressively capex. And if that portion of it happens in the in the second half of this year, then we could look at debt levels around 650 crores.
Okay, all right. We will leave it at that. Thanks a lot for joining in. Appreciate your time here. Let's take a quick break.
Thank you.
More on this on the other side of the break. We'll also have